You have heard how SIPs create wealth, but what if the same mutual fund investment could also give you a second income, like a monthly cash flow, just like a salary, while you're still working or even after you've stopped working or retired? So in this video, I will show you how to use SWP, that is Systematic Withdrawal Plan, a way to turn your mutual fund investments into monthly income cash flows. You will learn three different SWP strategies. One, starting your withdrawal from month one. Second, let your mutual fund investments, the initial ones, grow for a few years. Then you start getting income. Third is a unique model I call the Springwell method, where your income adjusts with market seasons. For example, a simple SIP of 15,000 per month with a 10% annual step up over 20 years can grow to 1 crore. Now this is possible with an assumed 12% per annum rate of return. But what is interesting is 1 crore can probably give you 50,000 per month as income for 25 to 30 years. And you can increase that income by 6% every year to beat inflation. Caution, not all withdrawal strategies are safe. There are tax traps, sequence of return risk, exit loads, and even the question of should you do SWP from an equity fund, hybrid fund, or a debt fund? So watch the full video. I'll break it down into clear step-by-step execution plan, including which funds to choose from, how much should you withdraw, what is a safe withdrawal plan, how to beat inflation, and how to manage risk, and a very powerful idea to prepare your portfolio for market crashes. So let's get this started. I've created a customized Excel calculator that will help you plan your SWP. And if you want a copy, just drop a comment below and I will share it with you. So step 1, you input the LO cells. You enter monthly withdrawal amount that you need. For example, I've entered 50,000 per month. That is 6 lakhs per year. Next, adjust the corpus needed. In this example, I've entered 1.08 crore as the initial investment amount needed to support that withdrawal. And if 1 crore corpus is very high, then you can tweak your monthly needs to a lower sum, say 25,000 monthly and 50 lakhs corpus, etc. Once you tweak, you will achieve what you are going to see now. In the next step, you add assumptions. I have assumed 10% annual return on your mutual fund investments, 6% annual increase in withdrawals to adjust for inflation. You can change these as per your requirement. This column tracks your corpus over time. For example, year 5, even after the withdrawals, the corpus grows to 1.17 crore. It peaks around year 16 at 1.42 crore and then gradually declines. By the year 28, the corpus reaches zero as withdrawals keep growing with inflation. Of course, these results depend on the input that you give, like inflation rate, rate of return, withdrawal amount, lifespan. This is just an illustration. It's not a promise, but even a rough plan is better than getting in blind when it comes to planning your second income. So we are discussing how a SIP converts into a corpus and then into a SWP. So what is SWP? How does it work? SWP stands for Systematic Withdrawal Plan. It is like the reverse of SIP. Instead of investing regularly, you are now withdrawing regularly from your mutual fund. You decide the amount that you want to receive and the frequency that is needed. For example, do you need it monthly or quarterly? Your invested money stays in the fund. It continues to grow while you receive a fixed cash flow. Depending on the SWP model, you may also withdraw your original investment plus gains or only gains. There are different ways to use SWP depending on your life situation. But today we will discuss 3 styles of SWP. First is the immediate SWP. You start from day 1. This is the simplest and the most tempting option. You invest a lump sum, say 25 lakhs or 50 lakhs, and then you start receiving monthly income from the very next month. So who is this for? It's perfect for retirees or anyone who needs immediate cash flow. There is no waiting, no delay. But the catch is you skip the compounding phase. your money does not get the time to grow before you start withdrawing. And if the markets fall early on, your capital might take a hit, especially if you are heavily invested in equity. So a good idea is to avoid withdrawing from pure equity funds in the early years. Rather, have a 3-bucket approach to investing your lump sum. That is, split it into 3 different types of funds. So for withdrawals planned in the first 2 to 3 years, use short-term bucket. Use low volatility funds like debt funds, arbitrage funds, or equity savings funds that cap their equity to 20% exposure. Use them for your early withdrawals. Just make sure to use funds that have no exit load. Some funds have exit load up to 30 days. For withdrawals planned from 3 to 5 years, use the medium-term bucket. Use funds like hybrid funds, balanced advantage funds, multi-asset funds. These adapt to market cycles much better and try to minimize risk. For withdrawals planned after 5 years, use long-term bucket. That is, invest part of your corpus in flexi-cap funds with the large cap bias. These are to aim for higher growth over time. So the key is to split your lump sum across these 3 buckets right at the beginning. This gives you both income now and growth later for the withdrawals. Now, how much can you withdraw? What is a safe withdrawal rate? Can you withdraw 12% per annum, or is 6% the right amount to withdraw? We'll talk about it in a minute. Also, check out this video that I did, which goes into the 3-bucket strategy of withdrawal in detail. So the next model of SWP is the delayed SWP, where you start withdrawing after 1 or 3 years. This is especially if you don't need income right away. This approach gives your investment some breathing room, some time to grow. Wait for 1 to 3 years before you start withdrawing. During this time, your money stays invested and it also compounds, potentially giving you a bigger cushion. This is ideal for someone who can manage expenses right now through other sources. Think of it like charging a mobile phone before switching it on for income. Now, what is the risk here? The delay phase is also a risk phase. If the markets were to correct during this time, the compounding benefit might not materialize. An idea is to use the delay to build growth buckets and rebalance them. Example, you invest the lump sum into a mix of 1, equity funds like flexi cap funds or large cap funds for long-term compounding. 2nd, hybrid funds like BAF or multi-asset funds. These can handle some volatility and smoothen the return. Let equity and hybrid do the growing during the delayed phase. Meanwhile, accumulate returns in the safe debt or liquid funds. So when SWP begins, you start withdrawing from the buffer first instead of selling equity if it's a bad time. The 3rd model is my personal favorite. I call it the spring-well method. It's sustainable SWP for life. Think of your capital like a spring well. It keeps refilling if you don't draw too much from it. In this method, you only withdraw the real return, not the entire growth. That means if your investment grows at say 12% annually and inflation is 6%, you withdraw 6% per year. Example, 1 crore is your investment. Fund grows at 12%, that is 12 lakhs per year. Inflation is 6%, then you withdraw 6 lakhs per year, that is 50,000 rupees a month. And each year, you give yourself a 6% hike in withdrawal to match the inflation. So your lifestyle is protected and your portfolio does not shrink. So your capital may stay intact even after 15-20 years. If in a specific year, the market goes down or worst, the market crashes. We will discuss this scenario in a while. Meanwhile, this style may be ideal for long-term income seekers without killing the golden goose. Many investors also keep wondering, what is the safe withdrawal rate? In the US, the 4% rule is widely quoted. But what about India? In a research study done by Arpit, it suggests that in the Indian context, a 3.5 to 4% withdrawal rate is likely to sustain your portfolio for 30 years or more, especially if the portfolio is well diversified with some equity exposure. This aligns well with our spring well method, where you're only withdrawing the real return, that is after adjusting inflation. But there is a caveat. What if there is a drought year? Let's say the market crashes 10% or 20%. Now, your spring well does not refill in summer. The water level drops. If you continue withdrawing full income during a drought year, your well will start drying up. So have a backup tank, 1 to 2 years of expenses parked in a liquid fund or an arbitrage fund for a bad year. Give equity the time it needs to recover. There will be droughts. Even the best funds can fall 10 to 20% every year. But with discipline, buffer planning, and the right fund selection, the springs recover, monsoon seasons will also come, and that will replenish your corpus. But there are some major risks in SWP that you must know. One, sequence of return risk. What if the market crashes right after you start your SWP? In that case, your capital can erode faster, especially in the early years. For example, in this worksheet, try changing the return to minus 20% in year 2. That is to simulate a market crash and see how long the corpus lasts. If you need help in customizing this for your own situation, feel free to reach out for a one-on-one meeting and we can work through those numbers. Second is about taxation. SWP is more tax efficient than FD interest, but equity funds long-term capital gains is 12.5%, and debt funds, the gains will be taxed at your slab. So use equity-oriented hybrid funds, equity savings funds, arbitrage funds wherever possible to take advantage of long-term capital gains of equity. Third, exit loads. Some withdrawals will be subject to exit loads, so be sure to identify funds with no exit loads. I hope you enjoyed the content of this video. If so, please hit the like button. Consider sharing this video to your friends and subscribing to this channel.